So one more thing, I just want to highlight to everybody is that I understand there's a word count for your GBA assignment questions. So do not worry too much about word count. Of course, as best as you can, stick to the word count, but let's say you exceed by 50 words or maybe 20 words, that's fine, right? So a word count is just to let you know how much uh, how much is expected. So, for example, if it's a 5 mark question and word count is 50, you know that you need not write so much, right? So it's just for you to gauge on the amount of explanation you require that you are required. So do not be too worried about word count. If you exceed a bit, that's fine. Yeah. So again, for for most of you, I hope you have started working on your GBA already. Yeah. Uh, Remember, if you do have any issues with your grouping, you cannot reach out to any members. Reach out to me. Let me know. We'll see what we can do. Normally, maybe the person has dropped out of the course, but did not inform. So we'll follow up with the person, right? But please reach out to your group members. Okay, so let's start today's lecture. Okay, like I mentioned earlier, today's lecture, the first part will be a bit more theory kind of um, component, more of an introduction to fixed income. All right, so let's look at fixed income industry. Fixed income might sound a bit strange. Why is it called fixed income? Basically, how you can think about it is you receive income on a fixed basis, right? That means you receive it maybe every month or every 6 months, every year. And what kind of instrument can give you income like on a fixed basis? That's right, T-bills, bonds, REITs. Yeah, right. So of course, REITs is more of alternative asset because you're looking at like real estates, right? Real estate investments. So you're right for like things like bonds, T-bills. So they generally give you a fixed income at fixed periods. So focus of today's lecture is on bonds, T-bills, etc. Okay. So just a kind of a high level understanding of fixed income industries. Generally, fixed income industry is a lot higher, or there are more issuance compared to equity. As you know that if you see this line, it's above the equity, basically because most of the governments, the countries actually issue fixed income bonds. The most common probably you heard is the T-bills, which is your treasury bills, which can be issued by any government, but the most common one is from the US because it's considered risk-free. So because of the issuance of government-related bonds, the uh, market out amount of security or fixed income security that's outstanding in the market is a lot higher than equity, which is typically from corporations. All right, so this is just another representation of the issuances of fixed income versus equity. In terms of the industry, we see that there's a good mix between all the various countries in the fixed income, global fixed income market. Because there's a larger tilt towards more developed countries, and emerging markets, of course, have lesser issuances because they are higher risk, and therefore, if it's such a high risk, people just go into your equity securities, right? Instead of going fixed income, unless the rewards are significant. All right. We do see so in the fixed income market, there's quite a few different kind of products. You have your treasury, which is your T-bills. You have things that's being issued or bonds that's issued by corporations. You have municipal, which is like cities, right? So in the US, there's federal and municipal kind of segregation. So the federal will issue the US treasuries, but your municipal, which like your states, or sometimes even your cities can issue fixed income instruments as well. You have some federal agencies that can issue. We will look at the details in a bit. You have some asset-backed kind of securities and other small money market securities. So type of fixed income, we first look at treasury, so your bills, notes, and bonds. Federal agencies, so you have your Fannie Mae, Freddie Mac. So these are generally more of your mortgage kind of agencies, where they can actually issue kind of like mortgage-backed securities. So it's like they typically issue this kind of securities or fixed income instruments where it is backed by your mortgages. So if these mortgages are issued by federal agencies, they are called agency MBS, right? So they're issued by these entities. However, if it's a non-agency MBS, they are typically called more private labels. That means the agency that issues these mortgage uh, can be more municipal kind of agencies and basically not federal. You have some asset-backed securities as well. So the difference between mortgage-backed securities and asset-backed securities is that, of course, mortgage-backed securities are against mortgages. Asset-backed, it can be against any other things. And I think in the last lecture, we're going to look at what kind of asset-backed securities that could be, right? We have corporate securities. So your corporate securities, if I know, I think a couple of you are in corporate banks, so you probably see this quite often. Things like commercial paper, corporate bonds. This is more common, and we'll go into the details in a bit, right? And last but not least, you have your municipal securities issued by your municipalities. Fixed income participants, you have your issuer, intermediary, right? Your basically your dealers, and finally your investors, right? Who is going to buy these products? Issuer is who issues the securities. Okay, so for the issuer side, we can have things like supranational bodies, things like World Bank, uh, but more common, it's sovereign or government, such as the Singapore government, US government. You might have certain cities or states, so these could be more your municipals. Uh, or you can have things like your quasi-government. So for example, in Singapore, we know that like LTA or HDB, they are no typically like government companies, right? But they're not the government agencies per se. So they can actually be issuing bonds as well. Most common, of course, is your corporate, or at least most common in the corporate world is the issuers such as your financial institutions issuing on behalf of corporations to actually increase their debt profile by issuing more bonds. Right? Sometimes the company can also issue directly if they want. So they include your non-financial institutions, for example, let's say Toyota can actually issue bonds as well to the market. Classification or type of issuer. So this is basically how we classify the issuer, right? So all these are quite a lot of detail. You can kind of look through it. Just broadly go through this with you. So this is how you classify issuer. You can classify them by the type, whether it's a government, corporate, or you can classify the issuer maybe by the quality, right? So like who are the issuer? Let's say, is it US government or maybe Indonesian government, right? So you know that the credit quality for Indonesia and US is quite different, right? So it could be something like this. Or you can classify this instrument by the maturity. So it can be overnight. So overnight, let's see, overnight is kind of just your very short term, kind of maybe fixed income instrument, can be something longer, such as your T-bills, certificate of deposits, commercial paper. Generally, they are still relatively short term. Last but not least, it can be longer term with 5 years, 10 years, and this is where your bonds come in, right? Your notes, bonds. Um, uh, for bond market index, nowadays it's quite popular to have ETFs of bonds because as a retail investor, it's a bit hard for you to buy bonds per se because one bond can be very big, right? So unless you have millions, then you can actually buy a full bond. But most of the time nowadays we buy indexes, bond index. So you have various indexes created by, is it Barclays or JP Morgan, where it tracks the bond index. Anyone knows or anyone invest in any bond indexes? No. Okay. No. Max risk, full equity, yeah, or full crypto. Okay, that makes sense because as a younger person, you can take more risks, right? So in fact, actually, you have a longer horizon. Yeah, you don't need to invest in bonds, at least not now. And equities, you can have a longer horizon to kind of have spread out your returns on your equity in case you have a dip when you can wait, right? Yeah. What is a UNC? Oh, uh, yeah, no, but I think even I think there's some research that's being done on average if you just invest in S&P um, until your retirement, it's much better than investing in bonds, right? However, I think people invest in bonds for different reasons. If they require, let's say semi-annual payout in terms of bonds, then maybe investing bonds is a good idea, right? So the the idea of investing bonds are quite different from equity. So maybe it's not about have at the end of like 50 years, what's the return? Maybe they're not looking at that, but they want uh, quarterly payout or semi-annual payout, right? So that's something that might be one of the reasons they invest in bonds. Bonds, we have primary bonds, secondary bonds. So basically, where are you buying your bonds? If you're buying your indexes that are more secondary or even tertiary, because your index is not even buying the bond, right? You're just buying an index on the bond. Kind of offerings. So in terms of the primary bond market, you have the firm or underwriter actually can buy an entire bond, and then this underwriter, it can be one underwriter, but typically it's a group of underwriters or group of banks. They syndicate the entire bond. So they split the bond. Let's say this one giant bond is 1 billion, right? So they split, let's say, into 10 banks, right? So each bank take 1 million. And then this is the amount they receive, and it might be the bond that they hold, right, on their balance sheet. But more commonly, they might actually sell it to or break it down into smaller commitment amount to other investors as well, right? So the type of offerings can be firm or it can be more of a best effort. So they don't for firm, as the name suggests, it's a fixed price, fixed amount. But if it's a best effort offering, then it, the investment bank or the underwriters will not guarantee the price that they're offering, right? You might see some bond auctions as well, and auctions are generally more towards the treasuries, right? And last but not least, if it's a self-registration, it is maybe you just register the price of the bond on the market. When we talk about auction, the most typical auctions are T-bill auction. So if you follow the US um, markets, you know that every few weeks, and in this case 13 to 26 weeks, there is this uh, sorry, not 2026, there's a weekly auction of these T-bills that happen. Uh, and when there's this auction happening, if you follow markets, they'll say whether, oh, is the auction is it a strong or more of a weaker auction? And this typically shows how the market is responding, right? So if it's a very strong auction, it shows that market is confident. And also they look at the different uh, maturity of the bonds has been auctioned, or not maturity, tenor of the bonds, right? So maybe the 30-year is a weaker demand compared to the 2-year. That could have some signals in terms of why the year is weaker. So let's say if people feel that, you know what, inflation is picking up, they are not very certain about the future, the 30-year option might be weak, right? And then people want to just lock in the price for a short term, or just want to buy a shorter term bond. In terms of this auction, so the bids are submitted by the government security dealers. The bids can either be competitive or non-competitive, right? So for competitive bids, you have to specify the bid price and how much you want, right? So it's almost like buying the stock. Let's say you buy a stock in the stock market, you can put what's the price you want to buy and the quantity, right? However, you know that if it's a competitive bid similar to stock, if it doesn't hit that price, you don't get it, right? However, in bond, what's interesting that you can put a non-competitive bid. So it means that you get this preferential allocation, but you basically agree to pay the highest price of the winning competitive. So you pay the highest price, but at the same time you get some preferential allocation. So non-competitive bid is capped at 5 million bonds. In the T-bill, there can be a single price or uniform price auction. So a single price auction um, or uniform price auction means that everyone is going to get the same, is going to pay for the same price, right? However, you might get different quantity of the bond, but you get the same price. And this is the current system in the US now. However, there can be more discriminatory or multiple price auction system, and this is more in the European region where they have different prices based on how much you bid for. Kind of offerings can be a private placement, so bonds are sold on semi-private. So recently you will see that at least in the US market, there's a push towards more private investments, or this kind of private placement type of investments, because the US government has signed executive order to allow their citizens to purchase into the private markets uh, using their 412. So those who don't know what's a 412, this is basically your retirement pension, right? So because of this executive order that's been executed, it means that as a citizen of the US, if you have a retirement scheme, it's similar to like our what is it called? Our CPF, right? Then you can take this money and put it in your private markets. So bonds can also be sold semi-privately, and these are considered as private placements. Registrations, basically get the permission to issue the bond, but then you do not issue until you feel that's the right time to issue, right? Uh, and at this time also, the issuer need not redo a bond prospectus. So if you have some chance, you can actually Google to search bond prospectus of, like, let's say, Singapore Power. It's quite interesting because it's a quite big document detailing a lot of the entire company's financial profile. It goes to the details of the company's background, where there are strengths, what are the risks. It's a very big document, so it's quite interesting. If you do have some time, you can just Google Singapore Power or even Keppel, kind of like big names. They do have their prospectus published. So your secondary bond market, this is where there is a first of all, it could be an organized exchange where sellers can meet to trade their bonds. Can be over the counter as well. So the bonds are being traded according to things like Bloomberg. Um, will work as well. So for example, this Bloomberg fixed income electronic trading platform. And majority of these bonds are typically traded over the counter, not really on exchanges. Even, I mean, that's possible, but typically they're over the counter. And in a similar sense to stocks, there's a bid-ask spread as well. So the price of the price at which the customer bid for and then sell, which is the offer price. The difference is basically your bid-ask spread. So there are some things like settlement. So there's a T+1, meaning trade date plus 1 day. Your corporate bonds can be T+2, T+3. In terms of sovereign bonds, so sovereign bonds typically have the sovereign backing, meaning the government backing of or the sovereign country's backing. So the rating of the sovereign bond would follow that of the country's rating, right? So for example, you have Japan, the Japanese government, you have UK, which is called GLITs or bonds. Germany, right? So in terms of sovereign bond, you can have a fixed rate kind of bond, floating rate, meaning that you are getting SORA plus something if it's a Singapore one. Inflation-linked bonds, basically they are bonds that peg their returns to the inflation rate. So people that buy this basically help to hedge against the inflation risk. Okay. So in most cases, when we think about treasury bonds, treasury notes, right? And we use this word quite loosely. We generally refer to these kind of bonds that are risk-free, right? Generally is the case. Of course, um, if the treasury notes is being issued by, let's say, Mexico, or in the most recent case is Argentina. Let's say if it is issued by Argentina, then it might not actually be risk-free, right? But in most cases, when we say about treasury notes, we refer to the ones from the US, and the US is the global currency, and so they are considered risk-free. Because they are risk-free, very low risk, their yield is actually very low as well. So there's some interest rate risk. Anyone remember what is the relationship between interest rate and the bond price? How are they related? Inversely, you're right. So that's right, inversely, correct. So when the bond price goes up, not bond price, sorry, the interest rate go up, then the bond price go down, right? So they're inversely related. So there's some interest rate risk related to the bonds, especially longer maturity bonds, because it means that your interest rate can fluctuate even more. There could be some liquidity risk as well. So, there's some classification uh, depending on when the bonds was issued. If it's recently issued, it's called benchmark. If it's uh, recently issued but still liquid, so not super recent, but it's just recent, it can be on the run. But if it's going to expire already, or not expire, it's going to mature, then it's more of an older issuance, it can be off the run, right? So treasury bonds are traded very actively on the market. They can be denominated in a minimum of 1,000. Or normally we call it par, right? 1,000, we assume par is 1,000. So in terms of the auction, generally we have so these are the auction dates. Of course, they fluctuate and change based on regulations, but typically the 2 years is done monthly. Your 3, 5, and 10 is done quarterly, and your 30 years is done semi-annual. Your non-government bonds, so this is where we see your local governments or your municipal actually issuing bonds as well. They generally use such state or city bonds to fund public projects within the state where government funding from the federal government is insufficient, right? So a bit different from how Singapore works, because Singapore is a city and a state, right? City state. Um, but in the US, because it's so big, you have the federal, and then you have city, you have a state, and then you might even have a city, right? And so let's say the federal government, let's say, give 1 million to the state, right? And then the state's like, oh, but we have this big project is happening, we need 1.5 million. So in order to raise funds, they might actually issue some non-sovereign bonds or local government bonds to finance a project. So these are not guaranteed by the national government. Rating might fluctuate depending on the city or depending on how it's being structured. So you mentioned about some quasi-government bond. I think in a Singapore context, we can think of it like LTA bonds, um, which are not really government, not government per se, but they are like government agencies. So we can actually say that they are quasi-government, or they are like almost like sovereign bonds, right? We can kind of put it that way. Supranational is your World Bank, etc. Municipal bonds, munis, issued by state, local government. What's nice to take note of is that such municipal bonds generally have some tax exemption on their interest. So there's some tax benefit of investing in municipal bonds instead of federal bonds. Um, However, the good thing is that for municipal bonds, they are still backed by the full favor of the municipal, right? Which I can be, if it's very strong, it's basically almost like the federal government. Corporate debt. So corporate debt, if you're in corporate banking, your most typical kind of debt would be your bilateral loan. So your bilateral loan, why is it called bilateral? It means that it's just between two person, right? So it's between the bank and the borrower, right? So borrower can be like, let's say, Singtel, right? Singtel is the borrower, and then I'm the bank, then it's a bilateral loan. Anyone knows how do you call a loan if it's a three-party loan? So if it's three-party, so maybe two banks, one borrower, it's a club loan. That's right. Yeah, club loan. So a club loan can be either two banks or three banks with one borrower, right? So it's like a club. So instead of just bilateral, it's party of two or three banks. Normally, anything more than that, depending on the size, we can consider it as a more syndication loan where you have multiple borrowers. Multiple meaning like 6, 7, 8, 9, 10, yeah. And usually the quantum is quite big. Other kind of corporate commercial papers and corporate bonds and notes, which generally have different repayment schedule. So the next few slides have some details on the corporate commercial paper. So commercial paper, I would say it's not that common in Singapore. I think it's used a lot more in the US. So in Singapore, we typically use the bridge loans. So if you want, so okay, commercial paper is basically a short-term funding to bridge certain period where the funds are required. For example, if a company issues a bond, and then this bond is going to mature, right? And the thing is, the market is not really in a good condition to reissue or refinance this bond or reissue another bond to refinance the existing bond. So given that the market is not in the right condition, the company might reach out to the bank to say, hey, can you issue a short-term commercial paper or a bridge loan? So in Singapore, we typically use a bridge loan, but in the US, they like use commercial paper. And they help to cover the gap between two long-term funding vehicle. So it can be two bonds or two, let's say, project loans. So commercial paper will help to bridge this gap. They are generally for commercial paper is quite specific, is very short, usually 6 months, but a bridge loan, which is it can be 1 year, 2 years, or it can be an option, right? 1 year plus 1 year, something like that, like option. So the credit worthiness of the credit rating of a commercial paper depends on credit worthiness of the corporation issuing it. Of course, your commercial paper can be rolled over as well. Let's say after 6 months, you realize the market is still not good, and then you want to issue another 6 months, you can of course refinance it or roll over your commercial paper. Um, So this is just some comments on commercial paper. Can have a look. In terms of this asset-backed commercial paper, previously before the great financial crisis, it was more common where you might have commercial paper backed by assets, but nowadays are not so popular anymore. So in a commercial paper, you have a bit of differences between the US and Europe. So in the US, what happens is that the commercial paper is being issued at a price, right? X price. So for example, in this case, it's issued at 10 million, 180 days commercial paper, 10%. It means the interest is this, right? 180 days is half a year. So what happens is that in the US, the investor pay this amount front, which is 9.5 million, and receive 10 million, right? So in aggregate, what happens is after 6 months, you get 500K. Now, in this sense, actually the return on at maturity is 0.5 divided by 9.5, right? So actually your return, if you buy this commercial paper in the US, is actually less than 10%. It's only 5.2%. So that's the tricky thing about the US commercial paper. You don't really actually get the 10%, you're actually getting less. Now, if you are buying the Euro commercial paper, this is where you actually get the 10%, right? So you pay 10 million to buy this commercial paper, and then you receive 10.5 million after that. So your return is actually really 5%. Sorry, in this case, you actually get a bit more. This one you get less, because this is this is per year, right? It's per year. So in the US, you're actually getting a bit more. Certificates of deposit or CDs. So CDs, in the simple layman terms, is basically just deposits, right? Let's say a company reach out to you as a bank, they put in money, you get a CD, right? A deposit. Um, but in this case, in a corporate world, we call it a certificate of deposit. Um, and they have some characteristics as well. They can be negotiable, means that it can be sold before the maturity, or it can be non-negotiable, which is quite common in the fixed deposit space, right? So if we put money in the bank, fixed deposit is non-negotiable, you can only get back your money at the maturity. CDs typically have various minimum denomination as well, which is 100K, different maturities, interest add-on, etc. So because the bank is giving you money on your deposit, if the bank is less credit worthy, right? Maybe lower rating, then you get more interest, right? So for example, if you compare like uh in our daily life, right? If we go and compare what is the fixed deposit rate for DBS versus let's say Maybank, right? Generally, you know that Maybank is a higher fixed deposit rate, and that's because um in terms of credit worthiness, maybe Maybank is less credit worthy than DBS, right? Of course, there are various metrics to determine the interest, but one of them could be this. So that's why you are taking higher risk by putting your fixed deposit in Maybank. Sources of repayment, bond sources of repayment. So um, basically, this section is just saying, okay, so yes, you have bought the bonds. How is the party going to pay you back, right? So if it's a sovereign bond, it's being paid back by the government. If supranational, it is paid back by the countries. For example, if it's IMH, then IMF, sorry, IMF, then it could be the member country in IMF. Um, securitized bonds, for example, your mortgage-backed securities or mortgage-backed bonds, then they are being paid by, let's say, the mortgage payment, right? So mortgage payment goes into this bond vehicle, and then as a bond holder of such securitized bonds, you get the payments, the distributed mortgage payments. So a bond can also come with some collateral backing. So this kind of collateral backing reduces the risk on credit risk of the issuer. Okay? So there's just a few comments here. A debenture is a secured bond in the UK or Commonwealth country, but they are not secured in the US. A covered bond can be backed by a pool of assets, right? So basically, a bond that has some underlying securing the bond. So type of collateral backing, you can think of it as whether it's financial assets or kind of pool of shares in certain things. It can be against physical assets as well, whether it's a plane, construction, equipment, um, or it can be an asset-backed kind of security, such as your mortgage payments, right? Where there's actually real flow, cash flow from the investors um, through the mortgage payments. So in terms of bonds, well, again, this one we'll look in the detail in the next lecture. There can be some enhancement to the bonds, right? And we'll look in detail what's this thing called credit trenching, where you actually divide the bonds in different tranches. Generally, the junior bonds or the senior bonds would have claim above the junior or subordinated bonds, right? And then we will look at quite a bit of detail on this waterfall structure in the next lecture on how this credit enhancement works. Anyone know, what's the most common, kind of subordinated bonds that's out there? So I repeat a question. Anyone knows what's the most common kind of subordinated bonds that companies can might actually have on their balance sheet? Mezzanine, payment in kind. Uh, yes. So if they relate to things like shareholders uh, bonds. So basically, the company issuing a bond to shareholders or directors, right, of the companies. So these are generally considered subordinated because they are more like intra-group or inter-group kind of lending, and therefore in a bankruptcy situation, generally these kind of bonds are considered equity, right? Not real debt. So this is one of the more common kind of subordinated debt or subordinated bonds that could appear in the balance sheet of a company. In terms of over collateralization, meaning post more collateral that's needed, and in such a case, then you are protected. You're more protected um, from any credit situation. It's also quite common to see this reserve account where you actually put money in a special block account, and this account is pledged to whether it's banks or investors and cannot be touched, right? So this provides some liquidity and guarantee that maybe let's say the interest payment or maybe the principal or not the full amount of principal, but certain amount of the principal will be paid back. External credit enhancement. So you can have some external related enhancement. So just now, this one is more internal, right? Internal meaning you are kind of either doing some enhancement to the structure of the bonds, you post certain collateral, reserve, etc. So it's internal. External, you can means that you can actually reach out to, let's say, other banks or getting some guarantees externally to actually enhance your profile or your credit. So this could include things like surety, insurance as well, bank guarantee, letter of credit. So all these are kind of your guarantee features that will enhance the credit of your bonds. The external can also include things like your cash collateral account. So this might be external. Why is it considered external? It could be account that is held externally by the syndicate, right? Of the if it's a syndicated bond, it can be held by the syndicate or the agents, and then this helps to mitigate any risk or if the borrower defaults the money has already been held in like we call it an escrow account by the agent. A bond covenant, or not only bonds, but generally even a loan, right? Bonds are loans. So loans or bonds, their covenants can be described in two ways, affirmative and negative, right? So how do I usually remember it? In case, eventually when you are working in a let's say financial institution, you see things that, the issuer is trying to promise the bank something, um, then this is more affirmative, right? So they are going to pay all the taxes, or they're going to pay interest and principal on time. So they're affirming these actions. So these are, or maintaining certain accounts or certain conditions. So these are affirming the lenders. So these are affirmative action. Another way to think about it is more the negative kind of restriction, right? And these are generally a bit more common. And we see these things like, oh, restricting amount of dividend payment, restricting kind of asset disposal, so or restricting certain ratios, right? Your ratio cannot be more than, let's say, your gross leverage cannot be more than 10%. Yeah, so these are all restrictive actions, restrictive covenants. When we look at bonds, there are generally two considerations: interest income. So how interest income is being taxed and how capital gain is being taxed, right? We are quite lucky in Singapore that we know that there's no tax on investment gains, meaning capital gains. Of course, your interest income is being taxed at your income tax level, right? However, in the US, um, our capital gains are also being taxed. So in the US, if you are a US citizen, your capital gains are generally taxed, I think, at 40%, 30-40%, which is actually very high. It means that, for example, if you buy NVIDIA stock and you have gained 30% over the last 5 years, unfortunately, let's say we estimate 50% capital gain tax, then 15% of your 30% gain is going to be taxed away, right? Which is quite unfortunate. So Singapore, we are actually quite lucky that we do not have any capital gain tax. Um, and so sometimes to get around this kind of interest income and capital gain tax, um, issuers might use different profiles to issue bonds. So it can be a discount bond. So discount bond, then you will be exposed to more capital gain tax. So discount bond, let's say it's a zero coupon discount bond, then you will be affected by the capital gain, right? Um, but you will not have any interest kind of income tax. All right. So in terms of bond principal repayment, you have your bullet. So you're going to pay full, you're fully amortizing. So you amortize it until the end. At the end, you pay zero, right? That means you're going to amortize both your interest and your principal together. Your partial amortization, it means that you're going to pay part of the principal and all your interest every repayment period. And finally, at the end, you have a small chunk to pay at one go. A sinking arrangement fund. So sometimes you might see questions like, oh, how do I enhance your structure of your bond? We can think of it using the sinking arrangement fund. So is this fund where you retire the portion of bond outstanding into this fund, and this amount will be kept in this arrangement so that it reduces the credit of or the credit risk of the issuer, right? So you have this sinking fund arrangement as well. Bond maturity. So bond maturity, it can be 1 year. So these are more your money market securities, your T-bills, 1 year, commercial papers, certificate of deposit, so they are 1 year related. You can have a longer, which is your more less than 10 years called note, more than 10 years called bond. Your perpetual securities means that they have no maturity, right? Um, I think in the industry, most people use notes and bonds quite loosely. So do not feel like, oh, how come it's less than 10 years, but it's considered a bond, right? So it's actually quite loosely used. Um, tenor. So just now, this is considered maturity. Tenor is basically more of the remaining life of the bond. All right. Okay. So actually cover quite a bit on just the theory of bonds, etc. Right? I understand it can be a bit dry. You maybe you're wondering how come we are talking about all these things. So this portion on this more of the background or the terminologies of the bonds, the idea of this portion is just to set you up in case you eventually go into a role when you go into your job that is relating to bonds. You might see these words pop up, right? So it's really to give you understanding on what all this means, right? Or if not, when you see these kind of terms, first goal is like, oh, what's all these things, right? So it's just more on that. Of course, but now with ChatGPT AI, it's easy. You can just search and get it explain to you the meaning of certain terms, right? But this is just more of a background kind of foundation of the various terms and terminologies. All right, do we have any questions? All right, no. Okay, so we're going to be going to bond pricing and yield curve. Let me just have a look. I think now is a good time. We do our break. So as usual, we do two breaks. Let's do our short break. We can come back in, let's say, 8:06 around that, 8:06, 8:07. And we'll go to the next part of the lecture. Okay. All right, welcome back. Okay, so let's move on to the second part of the bond discussion. So we talk about bond pricing and yield curve. Right, so we have covered more of the theory component. Let's talk about bond pricing. So this is probably something you have already covered before. So I'm not going to go through this, right? Just to show you, bonds have various coupons, payments along the way. And at the end, the important thing, right, for bond is that you will get back your principal and your last coupon payment, right? So this is the important part. You'll get back your last coupon payment. So just take note of this. All right. So we have some terminologies: par value, coupon rate, coupon payment. So can I check? Is this the first time you saw this, or have all of you all seen this before? Par value, coupon rate, and coupon payment. Yeah. Okay. Okay. So then we familiar. Okay, that's good. Zero coupon bonds are called strips. So basically, no coupon payments. So the interest comes from the difference between the price of the bond and the par value. Bond pricing. So this is the bond pricing formula. You'll never really need to ever use this because you just use Excel to do things. So do not need to worry. Just take note that the coupon rate is not the discount rate. So just read the question carefully. So the coupon rate is not the discount rate. Coupon rate just tells you how much interest you're getting, right? The small little cash flows that you're getting whether every year, every half a year. Okay. Okay. So we have just an example here. This example is important. It's a bit simple, but it's important. Let me try to explain to you why. Okay, so we have a bond price here. We have an 8 years T note with a face value of 100, coupon of 3.5 paid annually, selling at 103.5. Right? So what's the yield to maturity? So you have 8 years, right? So number of years to maturity is 8. Okay. So how we price this bond? Does everyone remember using this rate formula called equals to rate, and then you put in the details? Everyone knows this rate formula? Yes? Okay. So in most cases, you immediately use rate formula, right? So you probably ask me, hey, how come I'm using this like weird method where I'm doing an IRR and then write the cash flow? So because this module, we are going to tackle the bonds in a little more detail. Um, we will see later why we need to use this formulation. And the main reason is because we are going to have different discount rates for each period, for each year. So for example, year one, my discount rate can be um, let's say 3%. Your year two is 4%, right? You'll see this in a bit, right? We have 5%, etc. So because of this, then it becomes we cannot use just a rate formula like this. Of course, when you are given these different rates, you're actually not really calculating the yield to maturity. You'll be calculating more of like the present value of the bond, etc. Right? So one of the reasons why I'm using this method of IRR is to show you how we work with the cash flows, right? So this is the amount we have paid at the start selling for this. And I know every year you get like 3.5, 3.5, 3.5, 3.5, 3.5, 3.5, 3.5. And then for the 8th year, you have to pay the par value plus the last 3.5, right? So that's why you get 103.5. And then you basically use the IRR formula, internal rate of return, for the whole chunk here. Okay, that's how you calculate your yield to maturity. One thing to take note in terms of your presentation of answers using Excel, so you can actually do some screenshots like this, like screen capture of the Excel, but please remember to provide the column numbers, right? Because especially for this, you need to use, let's say, formula text to show IRR is B2 to B10. So the marker must know where are you talking about, B2. So you must show this 2 and then this is a B, right? So if in a situation where you not show these 2, then the market do not know where is B2, where is B10. And that's where if your answer is wrong, you might not get matter marks. Okay. So important thing to take note again, I repeat, please ensure that you include both the uh, column and your row alphabets and numbers respectively. Okay, so why we do this IRR again, I repeat, is to show the various cash flows and then determine the yield to maturity. Uh, a small thing, sometimes they can be a bit tricky. In case they say the coupon rate is paid quarterly, then you need to divide this 3.5 by 4, right? Just a small thing to take note of. And everything is exactly the same. However, at the end also, when you calculate yield to maturity, you must multiply by 4. Because yield to maturity is always on an annual basis. So if you have divided the coupon rate by 4, given that you have 8 quarters, right? 8 quarters here because of 2 years, divide by 4, 8, or times 4 equals 8. Therefore, you need to ensure that your yield to maturity is multiplied by 2. Sorry, but multiplied by 4 because it's quarter. Okay, bond, par bond, basically, when your interest rate equals to your coupon rate, your par, you have a par bond, meaning the par value equals to bond price. You have a discount bond, so discount bond, your coupon rate is less than your interest rate, and your discount bond means that your par value is higher than your bond price. So your initial bond price is low, and then your par value at the end is high, right? So there's a discount. So you are getting you buy at a discount, and then the price goes up. And then your premium bond is where your coupon rate is more than your interest rate. So your coupon rate is more interest rate. So initially you pay your bond price is more, and then if the bond price goes down to your par value, which is typically 1,000, right? So you are buying at a premium and then it goes down. So this is a pictorial version of how, or graphical version of how these three different bonds are. So the first bond is your par bond. So your par bond, the price is what you pay now. The selling price of the bond is your par value of the bond. All right. Now your premium bond is where you pay higher and then the price goes down to par. And your discount bond on the other hand is you pay lower and the price goes up to par. So if you notice that in this graph, we can see that there's this effect called pull to par. So pull to par basically means that the bond price is converging towards the par value. Now, this is why I say that there can be different discount rates. So recall in the last lecture we talked about the spot rate curve, right? Anyone still remember what is a spot rate curve and what did we discuss about in the last lecture about spot rates? So the question is, what is a spot rate curve, and what did we generally discuss about in the last lecture? Alex, a spot rate over time horizon and maturity. Okay, but what is a spot rate? Yeah, okay. So we kind of talk about the forward rate, right? So remember we were saying that the forward rate can be derived from the spot rate curve. Remember? And then we did some pricing of the swaps using whether there are two methods, right? Method one and method two. One of them used the forward rate, one used the spot rates, right? To price the method two uses the spot rates. So the spot rate is basically derived from the bonds, zero coupon bond spot rate curve on the spot rates. And so these spot rate are the yield to maturity of the zero coupon. So spot rates are the yield to maturity of the zero coupon bond maturing at each of these cash flow dates, right? And so we can either use the forward rates to derive the spot rates or the spot rates to determine the forward rates. So why are we talking about spot rates all of a sudden? So this spot rate, right, is basically a fundamental approach to pricing the bonds using a sequence of discount rates. So you're using different discount rates here. So instead of, let's say, saying that, oh, we're going to use risk-free rate of, let's say, 3%, right? Remember in your other modules, you say, okay, when I calculate my present value of bond, or we use the PV formula in our Excel, we just put risk-free rate as 3%, and then we just use 3%, right? But in this module, we are going to use a more fundamental approach where we say we should use the spot rates, or basically the rates at each of these year, to calculate the actual price of the bond. Okay. So we have an example here. Suppose we have the 1 year spot rate at 2%, 2 years spot rate at 3%, and 3 years spot rate at 4%. So you have three different pricing, three different rates, and they are all spot rates. So what is the price of the 3 year bond that makes 5% annual coupon payment? So we have a 3 year bond, right? So you know that every year one you're going to get $5, year two get $5, and year three, because the third year is going to mature, you get $5 plus the initial par of 100, right? So you see there are three cash flows. Now, at every year, the cash flows, the rates are going to be different because we're going to use the spot rate to determine the present PV, right? Present value here. So once you determine this, you discount it all the cash flows back to year zero. This is your present value of your cash flow, which is your price of the bond you're going to pay. Now, so you see how we have used the spot rates to determine the present value of the bond, right? Now, having done this, we know this is the price of the initial price of the bond here, which you're going to pay. And then from here, you can determine the rate of the or the yield to maturity of the bond. So you can either use actually the rate formula, it's still fine, or you want to use the IRR formula, which kind of show the cash flows, right? So initially you have a cash outflow of this amount, because it's the amount you pay for the bond, and you get $5, and last you get 105. And so then you calculate IRR as this. So that's one way of pricing the bond, right? Using the spot rates. We can also use the idea of a non-arbitrage pricing of the bond. So let's try to understand how does this work. So we have two bonds now. Okay, so we have 1 year semi-annual coupon bond. So it's a 1 year semi-annual coupon bond. You can actually replicate this by having two zero coupon bonds with different par value. Okay, so we have, first one, the bold here is a 1 year coupon bond. So what's a 1 year coupon bond means? It means that at the start of the time zero, you're going to be paying P, right, the price of the bond. Every 6 months, because it's semi-annual, so 6 months later, you're going to get a coupon of 4.5. And after 1 year, because it's only 1 year, right? It's only a 1 year bond. So at the end of the 1 year, you're going to get a coupon again and a par, right? So you have two cash flows coming in. So you have a cash outflow, actually it's a negative, right? Because you're going to pay money out, pay P, and then you get coupon of 4.5, and then you at the end of 1 year, you get a coupon plus a par. Now, this actually can be replicated using a 6 month zero bond. So this is a 6 month zero coupon bond. So a zero coupon bond pays no coupon, right? It just gives you par at the end. And now this 6 months zero coupon will have a par of 4.5. So imagine you have this zero coupon bond with a par value of 4.5. So you can create this by different par, right? So this is first one you can create with 6 months zero with a par 4.5. And then you have one more zero coupon, which is a 1 year zero coupon, which is two. So you're going to add one and two together, right? And this 1 year zero coupon, the par is different, the value of the par is different. So it's going to be 0.45 as your par. Now, you can actually discount this back to here, right? Using the discount rate given. Okay, and similarly, you can discount this back as well using the discount rate given. So in this non-arbitrage portfolio of number one, having a 1 year coupon bond and two zero coupon bond with different par value, we should have exactly equal, right? So this must equals to this, must equals to this. So let me just use a different color to show you. So this block must equals to this block, must equal to this. So this value here must be equals to, I don't know, yeah, it must be all equals. 4.5, 4.5, yeah. So exactly the same. So your value P here is can give, but it must be given by the discounted value of 4.5 and 104.5. Everyone understands this? Any questions? Okay. Let me see. Anyone else? All good. Okay. So so they must be equal. Okay. So maybe this one is a bit easy because you have done so many of these non-arbitrage portfolio questions already, right? So this is like, oh, again, a repeat. So in general, it means that your coupon bond, right? Your coupon bond here, given your coupon, must be equals to your zero, coupon bond zero, coupon bond zero, coupon. So it means that in this case, you only have two coupons, right? In this case, because you have a 1 year semi-annual, so you have your coupon of 4.5 and then your final payment, which is 104.5, right? So only two cash flows. So you just only need two zero coupon bonds to replicate these two cash flows of your 1 year coupon bond. Now, then, but in this case, if you have more number of payments, then you need more. Let's say you have more payments, then you need more zero coupon bonds. So in the case where the price of a zero coupon price of the coupon bond is more than the zero coupon bond, then there's some arbitrage opportunities available. And so if the price of the coupon bond is more, then you short the coupon bond, of course, because you're going to pay you more, right? You short it and then you long the zero coupon bond. And then you can make a profit, right? It's a risk-free profit, positive arbitrage profit for you. Okay, so this example is probably one of the more important example. So you really need to understand how this example works. So questions can be a different numbers or different number of bonds, kind of a variation of this question, right? So please understand how this question or how we derive these answers from this particular example here, right? So it's important. I'm just going to put a star here. All right, so let's try to understand what's happening here. So consider you have four different bonds, A, B, C, D. So you have four bonds now, and then you have bond D. Okay, so bond A pays 100 only at T1. Bond B pays 100 at T2. So these are all zero coupon bonds, right? Zero coupon bonds. So they just not going to pay coupons, they are just going to pay that lump sum, which is 100 at that date. Okay, we have the various prices of this bond here. Now, We have bond D, which is a coupon bond, right? This is a coupon bond because it's going to pay coupons. So this bond D is going to pay $5 in T1, $5 in T2, and 105 in T3. The question comes is, does there exist or does there exist an arbitrage opportunity? And if so, how can we make free money? Okay, so this is a question. So let's look at the how we solve this question. So we start off by putting the bonds A, B, C, D, right? A, B, C, D here. We know these are your zero coupon and this is your coupon bond, right? This is your coupon bond. Okay. So these are the prices that is reflected in our question, right? These are the prices that you have to pay. Now, we have this multiplier. What is this multiplier here? So a multiplier, right, basically say, okay, how many of these bond A do you need? Because we do not know, right? So it's like, how many of bond A? It can be half of bond A, one of bond A, five of bond A. So this is a multiplier that we need to determine. We don't know how many of bond A we need, right? Okay, so in time zero, we know that we're going to pay this, right? Let's say this multiplier, let's just say, example, the multiplier is 2. So we need 2 bond A's, right? Because remember, we're trying to make a non-arbitrage portfolio, right? Let's just say we need 2 bond A. So it's just, imagine it's 2, so it's negative 2 times 997. So this is the amount of money you have to pay at time 0, right? This is the amount that you have to pay on the spot on time 0 for 2 bond A. Now, of course, we do not know this 2 bond, whether it's 2 bond A or what, so we give it an alphabet of minus minus uh, MA times 97. Everyone understands this? Yeah, okay. So for time 0, we are going to buy all the bonds, right? We're going to buy. So it's all going to be negative. So you're going to buy M number of bond A. We're going to buy M number of bond B. We are going to buy M number of bond C. And then we're going to buy M number of bond D. Okay. Now, we are trying to create a non-arbitrage portfolio, right? So it means that these uh, must be equals to these, right? So A, B, C must be equals to D. Okay. So for your A, okay, so for A, we know that based on the question, A is going to pay $100 at time 1. Now, yes, it's going to pay 100, but we don't know how much of 100, right? Remember in the earlier a simple example, I say if we need 2 bond A, then we're going to receive 200, right? 2 times 100 in time 1. 2 times 100 in time 1, right? So we don't know, so it's MA. Okay. Similarly, for bond B, it's just going to pay you the par value at time 2, and time 3 is just going to pay you the par value of bond C at time 3. These are all zero coupon par bonds, right? They're going to pay par at the various maturity time. Now, on the other hand, your bond D is going to pay bonds of 5 times MD, because again, MD is the number of bond D we need. It's going to pay 5 at time 2, so it's MD times 5. And last but not least, it's going to pay MD times 105, right? How you get 105 is 5 plus the par of 100, right? This is the amount that bond D is going to pay. So we know that based on the concept of no arbitrage, it means that ABC, bond ABC, you add up all the bond ABC must be equals to bond D. So in other words, this, let me just use this color, this must be equals to 0. this must be equal to 0, and this must be equal to 0. Everyone understands this? Y must be equal to 0. Questions? Yeah. Okay. Okay. So you know that they must be equal to 0, yeah? No, this is the working here. So let's look at the first one first. 100 MA minus 5 MD must be equal to 0, right? So this is basically here. This part here, right? Must be equal to 0. 100 MA minus 5 MD must be equal to 0. So MA is equal to 0 0.05 MD. Okay. So just ignore the number of bonds part first. So just focus on this one here first. Now for time 2, the same thing. We equate them both together. And so MB equals to 0 0.05 MD. Time 3, we are doing the same thing. MC is going to be equals to 1.05 MD. Now, at time 0, okay, so we have already derived the 3 equation, right? Equation 1, equation 2, equation 3. So this is just substituting now these 3 equation 1, 2, and 3 back into the, where am I going to substitute it back? I'm going to substitute it back into here, right? Here, the three bond A, B, and C. So I'm going to substitute them back. So remember that bond ABC, the total of bond ABC is this, right? Total of bond ABC is this. MA minus MA times 97 minus MB times 92 minus MC times 87. So I'm going to sub 1, 2, 3 inside. So I'm going to sub this one, and this one to equate everything to an MD, right? So, and so this equals to 108, sorry, 100.8 MD, negative 100.8 MD. Okay. Therefore, so this is 108 MD. But now let's go back to this. How much are you pay for the MD? How much are you pay for MD? You're going to pay this, right? 102 MD. So your 108 MD minus 102 MD means that you have a small arbitrage of 1.2 MD. So where is the arbitrage now? So what can you do to make arbitrage? What must you do? Which bonds must you short? Which one must you long to make this arbitrage opportunity? Correct. You're right. Can everyone see this? You short MD. Everyone okay to see why you need short MD? Because MD is more expensive, right? MD is going to cost you, how much MD is going to cost you? MD is going to cost you 102, right? So remember here, MD is 102. So your MD is 102 means that you're going to short this MD and then you're going to use the money to buy bond ABC. And in doing so, you really make a profit already, even though the payoff is exactly the same. So there is an arbitrage opportunity here if you're going to short MD. Alright. So this shows you that an arbitrage opportunity, and typically maybe the question asks you explain in detail, right? Try to write in words. Yes, you have done the calculation that you get 20 marks already. The last 5 marks is explain. So this is just the explanation of how you can actually see. So a lot of words, but basically if you understand the calculation, is exactly what we are trying to explain here. So the explanation is a bit long-winded, but let's try to dissect this, right? So there's no arbitrage opportunity if the coupon bonds is equal to the zero coupon bonds, right? That's what I'm trying to say here. If the coupon bond equals to zero coupon bond, there's no arbitrage opportunity. In this case, In such a case, if we long 5, A, 5B, 5C, and we short 10, there's no arbitrage. Short 100 on bond D, there's no arbitrage. So this is basically on the no arbitrage side. However, based on your calculation, right, if we are going to get 5 bond A, 5 bond B, and 105 bond C, this will give us the 108, right? 100.8. Because I'm going to buy 100 bonds, 108, which is less than just buying 100 bond of bond D here, which gives you this one, right? 102 times 100. So it means that your coupon bond is more than your zero coupon bond. And so we simply need to short the bond D, and we can make some money by using money to buy bond ABC. So this is, if you understand the calculation, the explanation should come very simple. All right. Any questions? So this is an example. Of course, you got to read the question in your GBA, or I don't know, wherever, in case the question do adapt similar uh, uh, similar kind of questions, then you gotta read the questions and then see whether you need to write so much, or maybe the question, look at the amount of marks, maybe it's lesser, then you don't need to write so much, right? So my recommendation is read the question and see what do they ask, whether are they asking for pure calculation, are they asking for calculation and explanation, or both, right? But this is just an example for you to have a good framework, right? So again, if you see similar questions um, in either ECA or GBA to questions relating to what you have gone through in your lecture slides. Important thing is to first look at the number of marks, know what are the requirements, whether is it 100 words, 50 words. So by the word count and maybe even the marks, you roughly know what is expected of you in terms of the details, and so you can provide appropriate length of answers accordingly. Okay. Okay, we go to the last part of today's lecture, is on U curve, right? So U curve and U curve theory. So a U curve, right, basically gives you the various interest rates of a fixed income instrument, and you plot it on a curve, like a spot rate curve that we saw. And so this becomes a yield curve that shows you what is the yield to maturity of your fixed income instrument, right? Based on the different maturity dates. Can be a 1 year, 2 year, 3 year, 4 year. So you plot the points on the graph to give you the final the whole term structure of the interest rate, we call it, or the yield curve. So we study the yield curve generally to see the pricing of the securities, fixed income securities. We look for whether there could be some potential arbitrage opportunity, and also to predict some market expectation of future interest rate. So this is the main one, right? We look at yield curve, to plot to understand the inflation, because so inflation will affect your interest rate environment, right? So you look at yield curve to determine the future interest rates. So the slope of yield curve changes over time based on economic conditions and expectation of the future market conditions, and in particular, this includes your inflation, right? So your yield curve really shows your inflation expectation of the market. So treasury securities are default free, free from any default or so the credit worthiness does not affect the yield curve. So your typical yield curve is a positive yield curve. It goes up. However, there's a situation where it's inverted going down. There might be a hump or a flat yield curve. Anyone knows what shape the yield curve is in at the moment in our market and why? So the question is, what shape of the yield curve is the current market in at the moment? None. Okay, and why? So, yeah. So I think all of you are pointing to the right direction. So there's some of you are saying it's a bit mixed, right? I know it's F, so it's a bit mixed. It's a bit it's positive, yes, it's going up, but then it's also inverted because of the rate hikes to combat inflation. So all of you are saying the right thing, right? So yes, it's positive, but at the same time, it's also inverted because of the inflation. So yeah, you're right. So now the market's a bit awkward, right? It's not a clear positive yield curve, nor is it a clear like negative yield curve as well, right? So the curve is uh, changing almost every other month. And one of the reasons, like what you mentioned, is because of the rate hikes that is happening, right? Okay. Okay, so the yield curve are generally consist there are of course there are a lot of factors affecting the yield curve, but in general it's being uh, uh it's contributed by three factors, right? We have the real rate, so this is the rate of the treasury, not affected by the maturity, rewards for daily delayed consumption. Basically, it's because you need to wait this long length of time, or you have placed this investment in this amount of time, so you are guaranteed to get this real rate. Now, for your the one of the most important part is your inflation premium that is embedded in your yield curve. So if you expect inflation to be going up, that's which is quite typical, right? In a normal market, you should have increase in inflation over time, not drastic inflation, but just very small increase in inflation. All right, then it should go up like this, right? So your inflation keeps going up, it adds up to your interest rate. Now, at this point in time, there is expectation or hope, or people are hoping that the inflation is going to drop, right? Which is why we see some easing of policies, reducing of the interest rates. And in this case, when inflation premium falls, then it kind of contributes to the downward sloping interest rate or the yield curve. So what this means is that we expect in the future, in like let's say 5 to 10 years, our inflation will be less than what the inflation is at this point of time now. Now, on the last but not least, the interest rate premium. So basically, this is just your present value of your future cash flows from your bond. Generally, the longer your bond, the more sensitive your cash flows are, right? Because it means that your cash flows that is way out in the future is going to be discounted a lot, and therefore it's going to be very sensitive to your interest rate risk. So these three components contribute to your yield curve, and it will determine whether it goes up or down. So some comments on the yield curve. Generally, the most common is that the yield curve slopes upwards, right? Longer maturity would have higher interest rate premium. This makes sense, right? If you're going to lock in the money for longer time, you should get more interest, right? Um, Okay, so there's this comment here, liquidity preference might be right, that real rates are higher for longer duration rather than flat. So we'll look at this comment in a bit. Just put it in the back of my mind, but we'll look at this in a bit. But let's just think about it, right? In general, if you put in an investment for 10 years, you expect more returns, right? So higher interest rate. Now, in the inverted yield curve situation, this is a bit awkward where if you lock in your money for a longer time, you're going to get less interest, which is a bit awkward, right? So uh, this can be a case of expectation of recession. The inflation is expected to go down. Um, Generally, a recession also, we expect the demand for long-term funds to drop, right? People do not want to take long-term loans, and so the demand actually is on the downtrend. Or we can think that why is it inverted? Maybe the investor expect this central bank to reduce the rate in the future to stimulate economy, like what's happening now. We are reducing the rates, and so the future interest rate is going to be lower than the current interest rate, right? So there's going to be some easing that's going to happen. So in these few cases, your yield curve can actually be inverted. So we can actually use the yield curve to kind of make some forecast in terms of when a recession happens. For example, if there's a negative spread between the 10 years, sorry, 10 minus the 2 and 10 minus the 3 months, right? So 10 minus 2 is given here in this line here, and 10 minus the 3 months is given by this red line here. And so when these two falls into a negative territory, generally they signal a recession. However, the question here is, why didn't we fall into a recession last year or 2 years ago? Last year or two years ago, right? So I think there are some comments about how there's a tech rally. So you're right, there can be some tech rally. One of the main reasons why is that the labor market at a point of time, especially 2023, was actually very strong, and there's a lot of post-COVID stimulus in the economy, right? So the government gave out a lot of money, and so there's a lot of stimulus in the economy at a point of time. So we didn't immediately fall into recession when the curves are in the negative territory. Of course, a comment here is recession risk does not guarantee a recession will happen. Then the follow-up question is, will a recession happen at the end of this year? As most of us know already, probably not, right? The economy is doing very well. There's a lot of uncertainty in terms of geopolitical risk, whether it's between US and China. But in general, I think the the comments of a recession is less. There are some people saying that there might be a stagflation, right? However, a recession is not so much on people's mind, right? I think people are thinking more like the tech rally and a tech bubble, right? So if you follow the news, I think there's more and more people concerned about a tech bubble, but some people say, oh, that might not happen because in a tech bubble situation, generally investments uh, are not rewarded by improvement in productivity or improvement in profitability, and they're generally accompanied by the lack of cash, right? But in this case, um, in the current situation, yes, there's a tech rally, but it's accompanied by a lot of highly liquid companies that have a lot of cash. At the same time, there's a gain in productivity as well, right? Even though the gain is still quite minimal. And so because of that, maybe the tech bubble might not burst. Um, so the question is, what should we continue to look out for? We should continue monitoring various signals. So this data, your PCE, CPI, generally they are or your US related data. And I think anyone know what's the current situation of this inflation data or unemployment rate data in the market now? Yeah, inflation rose. That's right. I think there's some concern about this. Um, Even though there was a cut in the interest rate during the last Fed meeting, but then there's concern that there's increased inflation. At the same time now, I think a unemployment rate has been, if I'm not wrong, steady, but the number of jobs creation has been on a downtrend, and people are feeling, or the sentiment is that the labor market is getting softer, and people are not spending as much. Yeah, no problem. I think what's interesting is I think just today, LVMH, LVMH is the um, company that owns Coach, Louis Vuitton. They came out with record-breaking results, third quarter results. If you check the stock market now, I think the stock is on the rise. I think more than 10% increase. And this is a very positive sign, right? So if people are spending more on luxury goods, means that they might have more disposable income, and therefore um, there might be confidence in the market continuing to rally. Of course, then the other side of the argument is that this kind of there's an increasing divergence between the middle class and the upper class, right? So now it's not the lower class and the upper class. So the middle class and upper class, so meaning that the rich is really getting a lot richer and therefore continue to spend in uh, 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 excessive products. There's, for example, luxury bags, but then on the other hand, the middle class is being squeezed. So I think important thing to just take note, day-to-day movement is important. So continuously tracking the market movement. Yeah, so they are shedding more jobs, or I think what many people are saying is that many companies are not employing new positions. So when they use the natural attrition of the companies or of the employees, right? Natural attrition uh and not replace them, right? So not replace people that leave the companies. So you see less hiring, less job creation, and you see people also a bit more afraid to shift and move uh, to different jobs, right? So generally, when we see lots of job creation, that's a very positive sign, right? So that means people are moving the market, people are getting jobs, people are leaving jobs. So there's a good job creation. But now I think it's a bit stagnant. People are afraid to leave, and there's job created. Okay. The day-to-day movement of the yield curve, you can see whether it's moving downwards or upwards by tracking the yield curve day by day. And using this movement, we can determine, what is the monetary policies, what's the market sentiments like, and adjust our strategies accordingly. Okay. Okay. I see that it's almost 9. Let's just take one last break before we complete the last component of today's lecture. The last component, I do not think we'll take one entire hour. We might just take half an hour. So let's take a short break first before we go to the last part. All right. Add another to his handbag. Uh, yeah, okay. So maybe Justin is the one that is boosting LVMH shares. If you buy a lot of handbags, you can increase the top line. Yeah, record earning. Okay, so let's take a break. We'll come back around 9:06. All right. All right. Hope you have a good break. Now, we'll cover the last part of this lecture on U-curve theory. Um, so what's this U-curve theory? So the U-curve theory basically tries to explain, or is a theory of U-curves to help to explain the shape of the U-curve at a certain point, how the U-curve moves over time, and what can we infer from about the future from this U-curve, right? So there are three key theories that we're going to explore: the unbiased pure expectation theory, liquidity preference theory, and market segmentation or preferred habitat theory. Okay, there are three theories. There's this last theory called continuous time. This is more a quantitative theory, which we will not be talking about. But just know that they exist, right? There's this other continuous time model, which is more of the quantitative kind of theories. Okay, so for first theory, the unbiased or pure expectation theory. So what does this mean? Now, this means what? So we know about what's forward rate, right? We also know as a spot rate already. So this means that the forward rate implies the term structures are equal to the market expectation of the future spot rate. This is important. So it's the market expectation of future spot rate. So the forward rate gives you the market expectation of the future spot rate, which makes sense, right? We have kind of talked about what is forward rate. Is the spot rate in the future, right? So under this pure expectation theory, given this understanding here, then the forward rate is simply the expected future spot, where F1 is forward, F1 is forward rate, and E is expectation, R is the spot rate, right? Expected spot rate. E is expected, R is the spot rate. So in this case, we know that the spot rate can be given by either R, which is the 1 period zero coupon rate, and we know that 1 period zero coupon rate is just the spot rate, where you can represent it as Z, right? So you can either use the notation Z, or we can call it R, which is called the short rate, right? So there's multiple names, right? So the forward rate is the expectation of the spot rate Z, or the short rate R, right? It's just different notations, but they just, the forward is the expected spot. And this spot rate, this important part, follows the geometric average of the current expected short-term yield. So this is important. We have an example to show you what does this mean. It's the geometric average, which is just the next example. So we look here. There is an expected 1 year future spot for the next 3 years. So the future spot for next 3 years. So these are expected spot rates. So next 3 years is 6, 7, and 8. Right? So the expected spot for next 3 years is 6, 7, 8. Now, using this pure expectation or unbiased expectation theory, we can determine the 3 years forward rate using the geometric average of the 3 years 1 year spot rate, right? So this. So geometric is, remember, you need to the power of 1/3 minus 1. And by doing so, we get the forward rate as 7%. So the forward rate, the 3 years forward rate must be 7%. If it's not 7%, then there can be arbitrage taking place. Now, let's say the 3 years rate today, or 3 years forward rate today, is 5%. We know that there's going to be arbitrage because it needs to be 7%. If it's 5%, there's going to be arbitrage. But let's prove it that you can actually have a arbitrage. So imagine you borrow $1 now at 5%, right, per annum for 3 years. So using this forward rate of 3 years, we just compound it by 3, you get this amount. If we are using the spot rate, expected spot rate, given here, 678, we will get this amount here, right, in the 3 years. So we see that by using the spot rate, we're actually getting more amount of money, 1.2249, versus using the forward rate of where we'll get 1.1576. So we get an arbitrage of this. So we actually knew already from here that it needs to be 7%, but it's 5%. So that means this 5% rate must increase, right? The 3 years for it must go up so that it equals to 7, such that there is no arbitrage on the against the spot rate. So this is the pure expectation theory. The forward rate must be equal to the expected spot rate. Correct. Now, this explains the equivalence of the spot and forward rate. Now, in terms of the yield curve trending upwards at the beginning of the expansion, and is more likely to slope downwards at the end of expansion. So, how does this theory explain this difference in yield curve? Is explained by the demand and supply. So, in the demand in the expansion space, the demand for the business in the expansion phase will be high, right? When there's a high demand, the interest rate is going to increase because there's high demand. Now, if the economy is slow, the expected forward rate or future rate is going to fall because of low demand. Then on the supply side, people would like to typically smooth their income or their consumption, sorry. And therefore, if there's anticipated recession, they want to consume less, meaning they want to save more, and therefore they'll push the rates down. So this demand and supply side would cause the yield curve to slope up and down accordingly. Shifting the forward rate or the future rates. Right? Now, in this unbiased expectation or unbiased or pure expectation theory, it uses a few very strong assumptions that investors must want to maximize the return with no other considerations of risk. The expectation is held with absolute certainty. That means you expect this to happen. There's not going to be any transaction costs. And the investors view different maturity as a perfect substitute for each other. So having the 3 years, remember the 3 years forward rate is a perfect substitute by having the 1 year spot rate for year 1, year 2, year 3. But we know that it might not be a perfect substitute, right? Because there could be considerations of whether you want to lock in the 3 years versus a 1 year and then you roll over 1 year by 1 year, right? So maybe the rollover is better for your investment profile, let's just say that, right? So there can be different considerations, but in this unbiased and pure expectation theory, it's a perfect substitute for each other. Most importantly, it actually invalidates historical data. We know that the forward rate is not equals just to the spot rate. Anyone can kind of deduce why the forward rate is not equal to just to the spot rate or geometric mean of the spot rates. Okay, compounded with R. What does it mean? Compounded with R. Mm, yeah, different point in time. Okay, maybe not really. Okay, it's a bit of a tough question, right? So just now I kind of hint on this because the investor views security with different maturity with a perfect substitute for each other. Yeah, so there could be a change in interest rate in the future. That's right, right? So, and the reason why this will be important is because in the let's say we have a 3 years rate, right? We lock in the 3 years immediately at let's say 5%, compared to a 1 year rate which is being rolled over to the next year and roll over to next year, right? And when we roll over 2 times, right? 1 year, 1 year, 1 year, then this rollover could possibly take into account the change in interest rate in the future, right? Of course, then the question is, does it change to a better interest rate or worse interest rate, right? So it really depends. We do not know. But if you are a risk adverse, of course, risk adverse investor, then you want to lock in the 3 years rate immediately. But if you are a risk taker and you have expectation, let's say these are bonds, so let's say you have expectation that interest rate is going to go down, then you want to take on the rollover, right? You want to take on the spot rates every year. So I roughly I can tell that you're getting that, right? So in the sense that there could be other considerations in place, and historical data kind of prove that this is actually the case. There are other considerations, and this is where the liquidity preference comes in. So liquidity preference is a second theory where it says what? The liquidity preference says that the theory states that investor require a premium. So this is the important part, a premium for investing long-term debt. It requires a liquidity premium. Okay, so let's see, what does this mean? So in a situation of this, right, where Z, which is a spot rate of 1 year, equals to spot rate of 2 years, or 0.5. And the expected 1 year coupon rate 1 year from now, so expected spot rate 1 year from now, R2 is also 0.5. With this in mind, we can consider two portfolios, right? We consider two consecutive 1 year zero coupon, or we can do a 2 year zero coupon straight away for 2 years, right? 2 years zero coupon bond for 2 years. Now, if we do the 2 years zero coupon for 2 years, we can determine the expected value using the rate here, right? Sorry. So if the investor only care about the future rate, future expected rate, then these two portfolios should give an equivalent payout, which means that using the 2 years rate, right? Using 2 years rate must be equivalent to having the 1 year rate here, Z1, multiplied by the expected 1 year rate, which is portfolio 2. So this is portfolio 2, is given by here. 1 year must be equivalent to the immediately 2 years. Okay, and in this case, it means that we know that the Z1 and expected 1 year rate is 0.05, and so 0.05 is here. This is the expected value, right, of your bond. So this is the case where there is no liquidity premium, right? It means that it is the case of this one, right? Unbiased expectation, where having two portfolios, one which is immediately 2 years and one that is 1 year and then another 1 year is exactly the same, right? Where there's no liquidity premium. Now, we know that the future rate is only expectation. If the realized rate is more than 5%, like what one of you mentioned, the rates can be different. More than 5%, what will happen to the realized return? A higher rate will cause the price of the bonds to fall, right? It decreases. So we know also, like we discussed earlier, that a risk-averse investor would choose what? To lock in a 2-year rate for 2 years, 2 years zero coupon rate for 2 years immediately, because the risk-averse investor will not know whether the rate will increase in the future, causing the price to fall or the bond to fall. So a risk-averse investor would rather just lock in the rate immediately. We know it for certainty. And for investor to be indifferent, then the expected 1 year zero coupon rate, expected 1 year zero coupon rate must be equal to 5. Then you can become indifferent in both A and B, right? You are indifferent in both cases. So we can see now that, you know what, there's actually quite a few considerations here. Can you see that there's some considerations in terms of the risk? And so we can kind of tell like, hey, you know what? Actually, maybe they shouldn't be equal. They meaning that maybe the forward rate shouldn't be equal to the expected spot rate, which is the first theory. And historically, we found that the forward rate tend to be higher than expected spot rate, which means that there's a existence of certain premium that's added to the expected spot rate, which cause the forward rate to be higher. And therefore, on average, the curve slopes upwards, even though the average interest rate does not increase over time. So it seems that there's a premium added, and this liquidity premium increases over time, meaning that the longer it is, the higher the liquidity premium. However, it can actually be difficult to predict because you require some prediction of your expectations. So, because of what we have discussed earlier, we now know that there is this additional liquidity premium that should be added when determining the forward rate of our bond. So your forward rate equals to the expected spot rate plus the liquidity premium when the bond or the loan begins. So the forward rate is the sum of the expected spot rate plus the liquidity premium. And now this is called a biased expectation because it's not unbiased, right? Previously it's unbiased because the forward rate equals to the expected spot rate. But now there's going to be some liquidity premium, and therefore it's going to be biased theory now. Which means that the implication is that there's going to be an upward sloping yield curve, which results in a higher future interest rate and liquidity premium or both, right? Which is the result of the higher interest rate or liquidity premium or both. So if I hop back over to here, right, there's a comment on the pure expectation. Okay, if I'm just going to hop back to this slide here, liquidity preference may be right that the real rate is higher for longer duration rather than flat. So this is trying to say that it's because your forward rate equals to your expected spot rate plus your liquidity L. So because of this L, is going to cause your yield curve to generally slope upwards instead of being flat. Which makes sense, right? Because we know a yield curve either slope up or down, and of course, if it's down because of inflation, then the down, we explain all those, but generally slope upwards. And This is the existence of the liquidity premium that's causing this. Do we have any questions on this liquidity preference theory? Okay, good. Okay. Now, the last theory, which is kind of the simplest of all, is just a theory. The layman term of this theory is about is that there's a supply and demand on the type of maturity of the bonds. Okay, so let's look at what this means. So there's a different supply and demand. So the theory adapts the view that term structure reflects the expectation of the future interest rate and liquidity premiums, but rejects the assertion that risk premium must rise uniformly. So the investor and borrower have different maturity segments, or they call it habitats, right? And so the investor and borrower might go in and out of these different maturity segments based on supply and demand. So the whole idea is based on supply and demand. So maybe certain investor want a longer term maturity. Like for example, sovereign wealth funds generally have 30 years kind of maturity horizon, right? So they want a longer maturity. Compared to maybe a trader one just a couple of months, right? A short term, or maybe a treasurer for bank might want just overnight kind of maturity, right? So depending on the supply and the demand or for different maturity, then they will do so by finding the best rate to compensate the risk they're taken, and therefore this will cause the yield curve to slope up and down, flat or hump, depending on the relative supply and demand. Right? So your last theory basically just say, based on supply and demand, this will cause the yield curve to change accordingly. That's all. And then you have different investors and borrowers with different maturity. So we have the long maturities like your life insurance, pension funds. Your short maturity could include your banks. For example, the Treasury Department of banks generally have to square off their positions at the end of the day, and they might tap the repo market, the short-term borrowing market, to maintain certain asset liability profile, right? So these are your repos. So they're short maturities. The forces of supply and demand operates independently in two essentially separate markets, and therefore market segmentation of preferred habitat says that the yield curve is determined by the supply and demand within each sector. Right? So actually that's all for today's lecture. So today's lecture might seem a little lighter because again it's overview of fixed income, and therefore you don't feel that it's extremely, or I hope it doesn't feel like extremely taxing compared to the last two lectures on derivative. Hopefully this gives you a good breather before the last lecture. So I think, do we have any questions? Let me just pause the recording.